If you're the parent of a teenager or young adult and you are looking to give them a financial head start in life by teaching them how to invest, or perhaps you want to get them set up with investments, or perhaps as a parent, you just want to learn how to invest yourself because you have no idea where to start, what to do, or how to do it, then this video is absolutely for you. Over the past 30 years of stockbroking, financial advising, and now financial coaching, I've had the privilege to help literally thousands of everyday people make smart money decisions. Not fancy ones, not hype-driven ones, but simple strategies that work in real life. So in this video, I'm going to share with you the exact investment strategy that I used with my kids when they were teenagers, the exact strategies that they are still using today, strategies that are allowing them to build real wealth on autopilot behind the scenes, strategies that anyone can use, including you. Now, before we get started looking at the investment strategy itself, I want to share with you what I believe is the biggest enemy of your investment success, of your kids' investment success, and that is doing nothing. We live in an age of information overload. We listen to podcasts, we read books, and we watch YouTube videos like this one. And then because of this information overload, we get worried that we're not going to make the right decision. Please believe me that the chances are that any decision to get started investing is going to be better than just sitting with your money in cash as the years tick by. So please don't be one of those people that does nothing, that just parks this in the too hard basket, because I truly believe that doing nothing is going to be the biggest mistake you can make. So please just commit to taking some kind of action once you've watched this video. So what is the true secret of investment success? It's not very exciting. In fact, it's very boring, and that is time in the market. Time in the market literally trumps everything. Now, I have been an investment professional for over 30 years, and please understand when I say this, this will beat picking the best stock. This will beat picking the best fund. This will beat the best strategy. This will beat timing the market. Time in the market is the secret. And having the right investment mindset around this is going to be absolutely crucial to your success and to your kids' success. Time in the market is absolutely key. And this is why I'm so passionate about helping parents teach their kids how to invest. Because if you can get this right, they have plenty of time up their sleeve. And if they can get this right early, they are going to be set for life simply by following the simple strategy I'm about to share with you. So let's have a look at the strategy itself. We're going to keep this super simple because simple is always better when it comes to investing. And the first step in this process is we don't want to try and pick individual stocks and shares. Now, I know it is tempting to try or to want to try and pick the next Apple, the next Google, the next Amazon. But the reality is even the professional fund managers cannot actually pick the best shares, believe it or not, despite the fact they get paid so much money to pick and choose shares to put in people's portfolios. 84% of the, or 85% of the time in Australia, professional fund managers don't actually do better than investing in a fund that just says, all right, we're just going to pick the top 100 shares or the top 200 shares. And in America, it's 88% of professional fund managers can't do better than just investing in a fund that has the top 500 US shares. So very important to understand that if the professional fund managers can't do it, chances are you're probably not going to be able to do it either. So why even bother? Now, just to back that up, Warren Buffett, who is the most successful investor ever, he says that investing in index funds, so again, just the top 500 shares in America, or just say the top 200 shares in Australia, that eliminates the risk that comes with buying individual stocks, and it virtually guarantees profit over a long enough holding period. So even Warren Buffett's saying, well, when I die, 90% of my funds are just going to go into an index fund. So the second step in this strategy is to invest in index funds and exchange traded funds. So what is an index fund? Well, this is the formal definition. I will make it a little bit more practical in just a moment, but an index fund is a type of investment fund that tries to track the performance of a specific stock market index like the S&P 500. Now, the S&P 500 is the top 500 shares, the biggest 500 shares in America. They're just the top 500 because they're the biggest 500. In Australia, we have the All Ordinaries Index, which is the top 500 shares in Australia. We also have the NASDAQ, which is the top 100 tech shares in the US. All around the world, every country has its own index, which is the index of the biggest companies in that country. So instead of picking individual stocks, it invests in all or most of the companies in the index. It's a simple way to invest broadly and to keep the fees really low. So here is a really simple example. This is the ASX 20. This is the top or the biggest 20 companies in Australia. So you can see we've got ANZ and BHP and Commonwealth Bank and IAG, which owns NRMA, and Macquarie Bank and National Australia Bank and Origin Energy. Most of these companies you would know and potentially do business with on a day-to-day basis. That is why they're the biggest companies in Australia. So when you invest in an ASX 20 index, you're invested in all 20 of these companies. So index fund, one investment, you're invested in 20 different companies if you went with this particular index. Okay, now in a minute, I'm going to take you through some examples of exchange traded funds. And I want you to understand that this is education, not advice. So I've got to read this to you. Please note that this video is for educational purposes and not to be taken as financial advice. The investments I'm about to mention in this video are not buy recommendations. I am using them as educational illustrations only. Investing does involve risk, so please do your own research before making any investment decisions. So here is a small sample of the index funds that are available on the Australian share market. If you wanted to invest in Australian companies, you can see here the VHY, which is the Vanguard Australian High Yield Share Fund, or the A200, which is the Beta Shares Australian Top 200 Shares. If you invested in either of those, you would be invested into household name Australian companies. If you want to go international, you could go the IOO, which is the iShares Top 100 International Shares, which would include things like obviously Apple and Google and probably Nestle. It would include funds, again, still household name, but international companies. The IVV is the top 500 shares in America. And then you've got the Vanguard International MSCI International Share Fund, which is very similar to the iShares Global. Now, what I want you to understand is that with any of these funds, you're not going to go too far wrong. There isn't a right, there isn't a wrong. If you use the principles that I'm teaching you in this strategy, it does not really matter which of these that you invest in if you're thinking long term. Then, if you don't want to pick one particular, either Australia or America, or you don't want to just completely international, you can invest in what's called a diversified index fund, which has some international shares, it has some Australian shares, it has some smaller company shares in there, it has some emerging company shares in there, it has a bit of cash, it has a bit of fixed interest. That allows you with one portfolio to be very, very well diversified, and this is often not a bad place to start. So you can see we've got one here, which is a Vanguard Diversified High Growth. It just means it's got more money in shares and less in cash and fixed interest. And then if we go the growth fund as opposed to the high growth, it'd have just a slightly smaller amount of money in shares and a little bit more money in cash and fixed interest. But sometimes they're good ways to get started. Okay, so we're not going to try and pick individual stocks. We're going to invest in index funds and ETFs, but we've just got to start with one. Just pick one. So to buy index funds and exchange traded funds, we need to set up an investment account. Now, this is a little bit like setting up an eBay account so that we can buy and sell things through eBay. Now, in Australia, there's three really good options that I've come across that I've done my research on. We've got Vanguard, which is the biggest index fund manager in Australia. We've got Moomoo, who is relatively new to the Australian market, but ticks all the boxes. And then Pearler, which is a great investment platform for long-term investing, for the type of investing that we really want to do. Now, each of these three ticks these boxes. Firstly, they have a wide range of investments to invest in. Secondly, their fees are low. That is very important. Thirdly, they're easy to set up and use. Fourth, they have an auto invest feature. Now, this is really important. I'm going to talk about this more in a moment. They have an auto invest feature. And five, they allow you to start small. And once we've got one platform, we want to look at starting an investment strategy called dollar cost averaging, which means we do not need to try and time the market. This completely eliminates the need to try and time the market. So what is dollar cost averaging? Well, here is the definition. Dollar cost averaging involves investing the same amount of money in an investment at regular intervals of time, regardless of what the price of the investment is. So regardless what's going on in the markets, every single month we're investing the same amount of money. Now, this is a particularly powerful strategy, and I'll show you why. So let's have a look at a really quick example here. Let's say I have $2,400 to invest, and I'm going to invest it in $200 lots every single month over the next 12 months. And let's say the investment that I'm getting into, its unit price is $90. So in the first month, I can buy 2.2 units of that with my $200. Let's say it then goes up to $100. The price goes from 90 to 100. Woohoo, we're making a profit. That $100, now it's $100. I can only buy 2 units. So I can now buy less of it because it's worth more. But then let's just say we go into a bit of a downturn for a few months. And this happens regularly in the financial markets. What happens is it goes from $100 down to $80. So my $200 can now buy 2.5 units. Let's say it gets down to $50. So my $200 can now buy 4 units. Let's say it gets to $40. I can now buy 5 units. And then at its worst, it's gone from $100 down to $20, but that means I can buy 10 units. Now, as long as you're invested in a high quality index fund, the top 200 shares in Australia or the top 500 shares in America, you can invest in that with confidence, knowing that those companies aren't suddenly going to disappear. BHP, Commonwealth Bank, Telstra. Now, some of them individually might, but because you're invested in 200 or 500 of them, the chance of you losing money on this is negligible as long as you don't sell at the wrong time. So what we want to be able to do is, as it goes down, we can confidently buy more units as long as we have a long-term time frame. And then what happens is, as the investment starts to go up, it goes from $20 to $30. We can now buy less. It goes from 30 to 60. How much we can buy is even less. It goes to 80, then to 60, then to 90, then 110. But what happens is, you can see that 2,400 we've invested becomes 5,013 simply because we were able to buy way more shares when it was lower than we could when it's higher. And so our average buy price is very low because we were able to buy so many shares down here, which means that we make more profit. So over time, dollar cost averaging is a very powerful strategy. So here are the benefits of dollar cost averaging. Firstly, you can start small. $20 a month, $50 a month, $100 a month, depending on which platform you're in. It eliminates completely the need for timing. In fact, we don't want to time the market. We don't want to have to worry about it. We don't have to stress about when is the right time. We just want to invest every single month. Market crashes, when the market falls in a big hole and it's all bad news on the news wire, we don't have to worry about it, because when the market goes down, that actually provides us opportunities to buy shares like the Boxing Day sales. It's easy to automate, which we'll talk about in a moment, and it completely removes the stress, because we know that when it goes down, woohoo, we're buying more. When it goes up, woohoo, we're making profit. It becomes a very, very comfortable way to invest. And then we want to set up auto invest so that your investments just happen behind the scenes on automatic pilot. You don't need to remember to do it. You don't need to think about it. It just happens. So what I want to show you now is just very briefly a couple of snapshots from the Vanguard platform, which is the platform that I use. Again, no recommendations here, but this is the platform that I use with my kids to get them started. So I'm going to just share with you a couple of glimpses of what auto invest looks like behind the scenes. So on the screen here, you can see one of my daughter's Vanguard portfolios. You can see on the first of each month, $200 gets direct debited from her bank account. That lands in her Vanguard cash account about 3 days later. And then the next day, money is taken from her Vanguard cash account and invested into her index funds. So the plan is very simple, $200 a month. say $200 a month. So far, she's invested a total of $5,000 over the last couple of years, and they get invested into these products down here. Now, I've partially covered those up because I don't want you just copying what I've got here, but we've got that set up, so $100 goes into each of those funds. And it's very easy to change any aspect of this plan. You can change the day that it gets direct debited from, you can choose the amount that gets direct debited, you can choose which funds you're investing in over time. So there's certainly plenty of optionality here, and it is super easy to set up. So if we come back to the strategy here, we're not investing in individual stocks and shares. We're just going to invest in one simple index fund. We're going to pick one platform to invest in that index fund. We're going to set up a dollar cost averaging strategy and automate that process so that every month money is taken out of our bank account, moved to our investment platform. From the investment platform, it's then invested into the index funds, and that ticks along in the background like clockwork. And the last thing that I want to impress upon you is please do not listen to the news headlines or the market fluctuations. If you listen to the news, chances are you'll never get started investing. And if you listen to the news, you will probably end up selling at exactly the wrong time. This is a long game. We invest through the cycles. Here is the Australian share market over the last 100 years. On the left side, we've got a logarithmic scale, 100, 1,000, 10,000. The reason it's logarithmic is so that we can fit it on the chart. If we didn't have a logarithmic scale, the chart would be way up through the roof and we wouldn't be able to see it. What you'll notice here is despite the fluctuations, the market trends up over time. Now, one thing that I want to point out here is that you can see that we have falls of 70%, 47%, 57%, 55%, 57% on a regular basis. So I can guarantee that it's going to happen again at some point soon. Now, this chart is a little bit out of date. We're now in 2025, and so we're actually up around here at the moment, around 9,000 points. So the trend continues to be up. Yes, we are overdue a downturn. When it comes, that is an opportunity, not something to be worried about. So please embrace market fluctuations. They will actually help you improve your long-term returns. And as I said to my daughter this morning, I actually hope that we're going to see a significant downturn soon, because that's going to allow them to invest regularly down into that cycle. They're going to be able to accumulate more units of the investments they're in, which means long-term, they're going to have much better profits. Now, if this has been helpful, can I please encourage you to click the like button, because that helps my channel and this content to reach more families. And please subscribe, because every week I release more practical, no fluff money videos to help you and your family thrive financially. So please click like and subscribe. So let's go through a quick summary. Firstly, doing nothing is probably the most costly mistake. So please make the commitment to get one investment set up with one platform and just a small amount of money invested every single month. You don't have a lot to lose. So often it's just getting started that is the hardest step. And once you've got something set up, it's actually easier to then increase the amount you invested or to add new funds to it. So can I just encourage you, just get started. The second thing is that time in the market is the secret to your investment success. Not have I got the right strategy, have I got the right fund, have I got the right platform. It's very much about just time in the market. So if you're investing for your kids, get them started now when they're teenagers and young adults, because the compound impact of those investments will be significant over time. Then you want to make sure that you build your foundation first. Income's got to be greater than expenses. Make sure that you've got a budget to cover your known expenses. Have some kind of rainy day fund in place. Get rid of your high interest debt before you start investing, and then build 3 to 6 months worth of cash reserve so that you're never in a position where you have to dip into your investments during a down cycle. So foundation first. Then we want to keep it simple. One platform, one index fund, and then we want to set up auto invest. And please make sure that you're ignoring the noise. Do not listen to the chatter. You just want to set up one strategy and stick with it long term, and that will be successful. Thank you so much for watching this video. I genuinely hope that it has been helpful and that it's inspired you to get started investing yourself, or certainly get your kids started investing. And if you would like to learn more about the basics of finance, more about the basics of investing and money management, then can I encourage you to check out the link in the description below to my free Let's Talk About Money community. And please remember, it is the little habits and strategies like this one that you put in place today that can literally make $1 million difference to your future and to your kids' future. Take care, and I look forward to seeing you in the next video.